Hello and welcome to our next lesson in this module on private company modeling and valuation. Now we're going to jump into our actual Excel model here for the main case study in the course for this deal between Kakao Corporation for the makers of the Kakao Talk application and then Daum Communications, the other Korean internet company. Now, I'm not going to walk through every single aspect of this model because it's really here for you to go through largely on your own. But you can see that we have an inputs page over here that lists our two potential acquirers. The first company that actually did acquire Kakao Talk, and then this private consortium that was mentioned in the case study instructions. This is an all-stock deal or potential deal, and so it's based on the exchange ratio provided in the instructions. Based on that and the fact that we know there are about 43 million worth of new shares to be issued, we can actually figure out what the implied share count for Kakao Corporation is before this deal took place or was announced. We can also get to the effective offer price like that, because if we know the buyer's share price and we know the exchange ratio, we can just divide the buyer's share price by the exchange ratio, and that tells us roughly what they're paying for each one of Kakao Corporation's shares. So that's a little bit of work that we've done in advance. Then we have those different cases for the IPO, the reverse merger, and then the acquisition by the private consortium. So again, this is really for you to play around with yourself and see what happens in different cases. We will come back and perhaps end up modifying some of this later on, but this is our basic starting point. Now, if you look through the rest of the model, you can see that we have a page for the weighted average cost of capital. We have the projections for the buyer, although since this is a reverse merger, after the deal takes place, they are not going to own the majority of the company. For accounting purposes, we are labeling them the buyer since they technically do make the acquisition by issuing a certain number of shares. Then we have the merger model itself, which is very similar to some of the other merger models that we looked at earlier in this course and in the bonus case studies and elsewhere on the site. So we're not going to actually spend a lot of time on parts like this that are very similar to examples that you've seen previously, but of course we do still need to include it in this analysis. We have the balance sheet combination, synergies, we have a relative contribution analysis, which is something that you haven't seen yet, but which we'll be getting into and spending a whole lesson on in this set of tutorials. We have an analysis of the exchange ratios and terms called collars that limit how much the buyer's share price can fluctuate in a deal like this when you're determining the purchase consideration. So we'll see how those work and what we might want to recommend to the company for those. And then we have some more elements of our valuation, including comparable public companies and precedent transactions or M&A comparables. We'll get to those actually in the next lesson after this. And then our valuation summary and the graph that we typically make. So overall, this is a pretty straightforward setup. It may look a little bit complicated because there are quite a few different spreadsheet tabs here, but that's just because we have a lot going on. And then I didn't even mention this, but at the end, we also have our IPO valuation and financing model over here. So we'll be spending a couple lessons on that as well. Like I said, though, the focus here is definitely going to be on the aspects of this model that you haven't seen before. So that is why I'm skipping over things like how to calculate purchase equity value and purchase enterprise value, why and how we've set up the toggles here, other things like that, because you've already seen them and I just don't want to spend time on it. Now in this lesson, we are going to cover a couple of main topics. First, I'm going to tell you about where to find the information that we need to create this type of model. Then we'll get into the revenue projections for Kakao Talk. Then we'll look at their expense projections and the assumptions to make there. And then we'll look at the balance sheet and cash flow statement projections and how to come up with these numbers and what assumptions to use for these. Then we'll project the income statement for the company on both a quarterly and an annual basis because the deal closes in the middle of the year and was announced in the middle of the year. We'll project the balance sheet and the cash flow statement as well. And then we'll do a check of our numbers at the end. Let's start with the first point here, information sources. So Kakao Corporation at this point in time was a private company. And so if you looked at it and you simply tried to get information that was publicly available on them, you would basically come up with nothing. If you tried to go in and get their monthly active users, for example, or their revenue broken out by different segments, you simply would not be able to find this at all. So the way I found this is that we did a retroactive check, which is one of the strategies I outlined in the previous lesson on data gathering for private companies. It turns out that after this deal was announced and then executed, the buyer, or at least the buyer at the time of the deal that was issuing the shares to do the deal, Daum Communications, actually released separate financial statements for both companies that show their numbers separately and together, going all the way back to the beginning of 2013. So I'm pulling all these numbers from there. We have combined some of these expense categories. So for example, labor costs and fringe benefits we've combined. Some of the others, such as the outsourcing, ad agency fees, event fees, and others, we've also combined those. We've combined depreciation and amortization. So we've modified it a little bit, but we've largely left this intact, at least with the main top-level categories. Now, in the previous lesson, we talked about how often private companies do not present their financial statements in accordance with GAAP or IFRS. It's sort of true here that you have some non-standard expense categories. However, the difference is that we are dealing with companies based in South Korea, and as a result, we can't necessarily conclude that these categories are wrong or misleading because maybe this is just how other companies there do it. We don't know for sure because we haven't reviewed other companies' filings in the country. Also, even Daum, a large public company there, actually discloses its financials like this. So based on that, we're not really going to adjust this or move these to more standard categories. So we're getting a lot of the information from there. Of course, there's a problem, which is that the balance sheets that they disclose are not very detailed. Their statement of financial position right here. As you can see, the categories are very general and too general for our purposes. So that is one issue, but the rest of the numbers are all coming directly from there. They also give at the end their employee count historically as separate and combined entities. So we've taken all of it from right there. Now, for the rest of the numbers, they also released several investor presentations about this deal at around the time it was announced and then right after it closed. And if you go through here, this is where they disclose the number of monthly active users of the service, both domestically in South Korea and then globally as well. They go through and they repeat some of their financial information here. But the important part of all this is that at the end in the appendix, this is when they finally give us a more detailed breakout of the company's balance sheet, their statement of financial position. And so this is what I'm drawing it all from. Now, one thing that's a little bit weird here is that this deal was announced after Q1 of 2014 had ended. However, it closed after Q3 had ended. So as a result, they're showing us the actual historical financial statements for Q2 and Q3 of 2014, but we are pretending that we don't have those yet. So we've made our own projections and our own assumptions for this period beyond the end of Q1, and we're assuming that on a historical basis, all we have is Q3 of 2013 through Q1 of 2014. And on the income statement side, all we have is Q1 of 2013 through Q1 of 2014. Now, there is still one remaining problem, which is that they do not provide a cash flow statement anywhere. Now, if you look in Daum's separate financial statements and their investor presentations, they have some simplified cash flow statements, but they're not terribly useful to us because we need the cash flow statement of the seller, not the buyer in this case. So we are just skipping over that for now, and we'll come up with our own simple cash flow statement. So that's a little bit about where we're getting all this information from. So with that done, let's move on to step 2 and go through their revenue projections. Now, I'm going to warn you in advance as we go through this model that I'm not going to go through every single last detail and show you every last formula link here because we just don't have time. So with a company like this that does mobile messaging, really the key driver is monthly active users, which we have on a quarterly basis here, and then revenue per monthly active user. Sometimes this is called average revenue per user or ARPU, but here we're just making it revenue per monthly active user. And this has gone up substantially over time in all these different categories: advertising, games, commerce. So essentially, as more users sign up for the service, they're spending more on buying games and making in-store purchases and in-game purchases for the games they already have. They're spending more buying gifts for people, and we can run the numbers and figure out what all these are. Now, I always want to get to the annualized number for this, so that's why I'm multiplying by the number of periods in the year and then dividing by the total monthly active users up there at the top. But that is the basic idea for what we're doing. So we're going to be assuming that both of these numbers increase, that they gain more users over time, and that the average revenue per monthly active user also increases by some amount across all these categories. The other revenue is a bit of an exception because here it's not clear whether or not it should really be tied to the number of users. It probably should be in some sense, but we're just assuming a simple percentage growth rate for this one because it's so much smaller than the rest. Now, with these revenue projections, we think it's a lot more credible that the revenue per user is going to be responsible for more of the increase as opposed to the user count itself, because the South Korean market is already essentially saturated at this point in time. Even if they expand into Southeast Asia, if you look back historically, this hasn't been going that well for them. Because if you look at their investor presentation, for example, where they list the monthly active users, globally, the number of users has actually fallen in the past 4 quarters. So yes, it's probably going to increase over the long term, but it doesn't appear to be going that well in Southeast Asia and other regions. Many of the per monthly active user metrics, though, we think could potentially double over the next 1 to 2 years, given how quickly they've grown historically. They won't grow quite as quickly over a 5-year period, but they could still increase by some amount. So let's go over, and I'm just going to paste in the numbers that I have here just to save us some time. So I've just pasted in all the assumptions here. We can see that our monthly active users has been split out into South Korea versus global. Global is decreasing until it reverses the trend and starts increasing again in 2015. And the South Korea number is increasing by a small amount, but it's already so saturated that it can't really go up by all that much more. On an annual basis, it's much the same idea with both of these. The revenue per monthly active user, you can see it's going up quite a bit annually here in this next period from about 1,500 won, about $1.50, to 2,300 won, about $2.30 in US dollar terms. And the same applies for games, although this actually increases by a lot more, and then commerce also goes up as well. And again, if you want to see the support for these trends, just look at it historically. It has roughly doubled over the past year or past 15 months. The games per monthly active user, that revenue has also increased substantially, and commerce per monthly active user as well. These projections might be somewhat aggressive, but of course, we're also going to build in toggles as always with this. So first off, let's input all the monthly active users for this period and link to all of this right here. So just summing these up and then copying them across. Now the post toggle growth rates here, as I mentioned in the instructions at the top, we're only going to look at these on an annual basis. So we're completely ignoring them for these quarterly numbers because they're smaller. It just doesn't matter as much. And you're going to see more of a difference when you let this vary over the long term instead of the short term. Also, it gets very confusing making these adjustments for annual versus quarterly toggles if we have something like this. So with that all set up, let's go over to the side now and actually fill in the rest of this. We already have this index match formula that retrieves the monthly active users for the relevant category here. I am not going to explain how this works because we covered it previously in other quarterly and interim projections. So go back and take a look at those. Take a look at the case study on the more advanced 3-statement projections or the more advanced merger model for more on that. What I will do, though, is finish this process of determining the total number of monthly active users each year. So to begin that, we need to take the baseline growth rates and multiply by the toggle. Let's say the MAU growth toggle for monthly active users. Copy this around. And then for the actual monthly active users, let's take the old number and then multiply by 1 plus the new percentage there. And we just sum those up. So we have the monthly active users, and then we need to figure out the post-toggle annualized revenue per monthly active user. Let's set this up by just taking our advertising per monthly active user, multiplying by the revenue per monthly active user toggle. And then we can copy this around. So we have this. With all this in place, and with our other revenue growth rate set up, we can actually just go down and fill in revenue on the income statement for the quarterly numbers and also the annual numbers. So for advertising revenue, we need to take our advertising per monthly active user and multiply by the total monthly active users in Q2 and divide by the number of periods in the year to convert this back. Let's also anchor the 38 part of the L38 there, and we can copy this around. For other revenue, let's just take the old number and multiply by 1 plus the growth rate right here, and copy this across. And then we can just take this and copy this formula all the way across as well. Now for the annual numbers here, we already have some if formulas set up, so I can just copy these across for 2014 and 2015. And then for the others, we can start by taking the existing formulas that we already have inputted right here, but we have to make a few changes. First off, we do not want to divide by number of periods in year anymore. Second, we want to divide by the post-toggle number instead. So instead of W49, we need to be taking W54 right here because we want these post-toggle numbers. We still have our monthly active users at the top, and so all the rest of this is fine. So we have that, and let's copy that down. And then for this other one, we're not modifying other revenue with a toggle or anything like that. So we can just keep essentially what we have right there. And let's copy these across as well, so we have that in place. That gives you a flavor of the types of things that you have to do when you have a mixed quarterly annual model like this. Like I said, it will get very time consuming to show you everything here, but that gives you at least a flavor of the types of adjustments you need to make and what you have to do. We can also go back in and fill in a few loose ends here for the growth rates, for example, because we actually have these as figures now. So we have those set up. That really takes us to the end of the revenue projections. For the expense projections and then the balance sheet and cash flow statement projections, I'm not going to spend as much time on this, and we're going to skip over large portions of how you actually tie these out on the statements because I want to focus more on the rationale instead of all the mechanics. I'm assuming if you've made it this far in the course, you already know the mechanics pretty well. So with the expense projections, the idea here is that very similar to what we saw with the other example for this business, Capital Capable Media LLC, we're tying a lot of these expenses to the number of employees that the company has. Because of course, the main expense for them is employee costs, as you'd expect for an internet or mobile company. So we're going to tie the number of employees to their revenue and then assume a revenue per employee figure, assume that the employee count increases and that the average expense per employee spent on salaries and benefits and so on also goes up over time. Other major expenses include paying out commissions because remember, if developers create games for the Kakao Talk platform or for any other type of platform the company has on smartphones, they're going to receive a commission when people buy their app or otherwise spend money in their app. So Kakao Corporation takes a cut of it, but then they pay out a good portion to the developers as well. And then a lot of these other expenses are just really going to be percents of revenue and will follow historical trends or just hold them constant in percentage or absolute Korean won terms. Let's go over and take a look at our expenses over here. You can see exactly what I was referring to, that we have the number of employees and then we have the annualized revenue per employee over here. This is actually pretty impressive because converting this back to US dollars, essentially this company is earning around 400 to 500,000 US dollars per employee that it has. That is pretty impressive for any company. For an internet or software mobile company, it's not shocking that they would have something that high for this figure. If you look at much larger companies like Microsoft and Google, they'll have even higher figures. But for a growing startup that is presumably still spending a lot on growth, this is actually pretty impressive. For the annualized labor costs, there isn't really too much to say here. We're just taking the labor costs and benefits from the income statement and then dividing by the number of employees. We're also making that adjustment to get these on an annualized basis, so we're multiplying by the number of periods in the year, 4 in this case. And then the rest, like rental fees, advertising, other operating expenses, D&A as a percent of revenue, these are all just percentages. And for the most part, these tend to jump around quite a bit. So in a lot of cases, we are just going to be using simple averages for these. Okay, so once again, I've copied and pasted in large portions of this just to save us some time. But what I can do, just to show you how more of this works, is give you the formula for the number of employees. To get this, we are going to go all the way down to revenue here, and then multiply by the number of periods in the year, and then divide by the annualized revenue per employee over here. So you can see that this is going up over time. We assume that we get a slight benefit and that we do not need as many employees as we get bigger on a revenue per employee basis. So that's why it's going up from around 470 to 510, a modest increase. The labor costs are also going up by a very modest amount here over 2 years. Again, historically, they have increased from about 90 or 95 to just over 100, although they did go up greatly in Q4 of 2013. And then for the rest, there's really very little to say. We're really just continuing historical trends there. And in general, with these types of projections, we want to make sure that the company's margin stays in about the same range going forward, unless we have reason to believe that it's going to change significantly, which we really don't here. And then for the number of employees on an annual basis, we can just link to our revenue. Don't ask why, but I happen to memorize the cell number, W124 there, and then divide by the post-toggle revenue per employee, which brings up the very good point that we haven't yet calculated this. So let's take this and then multiply by 1 plus the revenue per employee toggle. And then we'll also do the same thing for the game percentage, or the commission paid on game revenue here. So 1 plus commission games toggle. And we'll copy that across. So we have all that set up. I realize I skipped over parts of it quickly because we just don't have time here and there isn't too much interesting to say. You probably understand the basic methodology behind projecting this type of company's expenses now. With the balance sheet and cash flow statement projections, there's also very little to say. You have to be careful to use the annualized version of numbers, and you have to make sure to reflect the fact that since the company is generating so much cash flow and so much excess cash, it's putting that to use buying securities and investments, so we want to continue that going forward. Capital expenditures and D&A are small for this type of company, but we do want to have those, and we want to make sure that CapEx spending stays ahead of D&A going forward. So here are all of our drivers. You've seen these before if you've been through this course. So once again, to save some time, I'm just going to paste in our assumptions. Okay, so we have a more finished version of this now. Very briefly, accounts receivable as a percent of annualized revenue doesn't really follow a trend, so we're taking the average. The others do follow trends though. So we are making other assets as a percent of revenue decrease. We're making other current assets also decrease. Other current liabilities as a percent of annualized operating expenses is generally increasing over time. And the provision for long-term liabilities isn't really following a trend, so we're making that an average as well. For these other items, selling and purchasing intangible assets, it's very small, but we'll assume something going forward because we do have amortization going forward as well. And then the others here are all very small, but we have them just to be complete. The change in operating assets and liabilities, you can go down and take a look at the formula. The problem is we haven't fleshed out the actual balance sheet yet, so a lot of these are blank. In fact, they're all blank in this future period that we haven't yet projected, but you can see the individual items that actually go into this. We're going to make this in future periods a percent of the change in annualized revenue. Just like we've done before, usually when companies increase their revenue, it requires working capital to do that. When revenue decreases, often it frees up working capital. So that's the basic assumption here. And then we have securities. It looks like they're alternating and buying a lot in every other quarter and then not buying as much in the quarter after that. So we've stuck to that assumption as well. And then CapEx at 3.1 to 3.5% of revenue pretty much always stays ahead of depreciation and amortization if you go up and look at the numbers. On an annual basis, it's really much the same story with all these. A few of the percentages are changing slightly, but in general, we don't have anything too major going on here. And a lot of these have divide by zero errors right now because we haven't filled in the other financial statements. So we have the assumptions for that set up. Let's go up and see where we're at. So we have all of our assumptions fleshed out. For the income statement projections, it really is pretty straightforward. We're just going to link in everything from our assumptions above. And for the balance sheet and cash flow statement, same idea. I'm going to skip over large portions of this once again because we just don't have time here without turning this into a 3-hour lesson showing you all the mechanics. If you want to practice, you can consider this your exercise. So you can take a look at everything that we have actually filled out so far, which is not really all that much if you zoom out and take a look at it. And to get some practice doing this yourself, you can go in and flesh out everything here. So do it for the income statement, do it for the balance sheet and the cash flow statement. You can even include the key metrics and ratios. Do all of this on both a quarterly and annual basis, and then make sure your cash at the bottom of the cash flow statement links up to the cash on the balance sheet. You can pause the video right here, try it yourself if you want. If not, and you feel like you already have enough practice with this type of thing and you want to focus more on other aspects of this case study, then forget it and just keep watching or move to the next lesson at this point. Okay, welcome back. As I said, we skipped over portions of that because you've already seen this before, but with this finished version of the financial statements, there are a few things I want to point out very quickly. So first off, the income statement for the most part is very straightforward. One thing I will point out is that in the interest income calculation, we are factoring in whether or not circular references are allowed or not. If they are allowed, then we are taking the average and we're using cash plus short-term financial instruments. We're doing that because presumably the company is earning interest on both. It really has no reason to be buying so many short-term financial instruments if it is not earning interest in some way on those. And then also remember with this that above we had the annual interest rate. So I'm dividing by number of periods in year once again to make this a quarterly figure. So that's one thing to point out there. Interest expense is always set to 0, so we're not worrying about it too much. And then with the annual numbers over here, largely it is the same as what we had for the quarterly numbers, except you have to remember that on an annual basis, you don't need to divide by the number of periods in the year or multiply by the number of periods in the year or anything like that. So moving down, we have equity investment net income and net income attributable to non-controlling interests. This is actually something that we could arguably change. And the problem here is that we started bringing in this line item for net income attributable to non-controlling interests, but If you go up further where we have the change in non-controlling interest, we actually set that to 0. So we didn't have anything there. As a result, it doesn't really make sense to have this type of line item. So we would argue that it's better just to set this one to 0. It's not really even going to make a difference in our valuation or anything else here anyway, but it's a little bit more logical to do that. I can already anticipate that someone is going to ask a question about how we can have these types of items and how we can have them on the income statement, but then not do anything with them afterward. The answer, as you know, is that we should really start the cash flow statement with net income attributable to non-controlling interests. Then we should reverse the signs on these and add them back or subtract them out, and then link them to something on the balance sheet. We should link the equity investment net income to the long-term asset that corresponds to it. It's probably within other assets here. And then net income to non-controlling interest should be linked to non-controlling interest down here. We're not doing that because we're starting the cash flow statement with the net income before these items were factored in. So we're skipping over it altogether. It's a simplification. We're just trying to save time and we're not worrying too much about very minor items like this that aren't really going to impact anything else here. So that's the explanation for that. The key metrics and ratios, I don't have much to say because it's just copying and pasting all those formulas across. We already had part of them set up before. We can see that growth-wise, the company goes from growing around 60% down to more like 20% per year. Margins continue to remain very high, around 50% operating margins and 52 or 53% EBITDA margins. So it's actually an even higher margin business than the very small private company that we looked at earlier, which is not unexpected. Sometimes you do see this type of thing happening, especially if it's in a space like this where the products themselves or the services have essentially a 100% or a 90% or other very high gross margin percentage. It is definitely possible to have a business that is at this scale and also extremely high margin. Now going down on the balance sheet, again, there isn't too much to say here. You just have to be careful to annualize numbers when you're looking at them on a quarterly basis. So accounts receivable here, for example, we're multiplying by number of periods in a year. But then if you look at the annual numbers, we're either using index and match to get them, or for the ones that we're actually projecting, we're just not multiplying by number of periods in year at all. So this part overall is quite straightforward. You should already know how to link in plants, property, and equipment, link to CapEx and depreciation on the cash flow statement to project that for both the quarterly and the annual periods. And same for intangible assets. Other assets is being linked to revenue here, so we do something different. And then for the rest of this, there really isn't that much to say. Non-controlling interest is an item on the balance sheet, but we are just assuming it's 0 and stays at 0. In real life, it actually changed and it increased to a positive number here as they got some type of non-controlling interest, but we are completely ignoring that for simplicity in our analysis. Other than that, if you go over to the annual projections, once again, the main theme is that when you're actually projecting a number directly on the balance sheet, you just have to be careful about not multiplying or dividing or doing anything else with the number of periods in the year, the 4 quarters here. Now, moving down to the cash flow statement. So first off, we don't have historical cash flow statements for the company at all, which creates some challenges, but also makes some things easier. We don't have to worry about following trend lines or condensing a very complex cash flow statement into something simpler. But we also then have to create our own cash flow statement going forward, which we did do based on the company's relatively simple balance sheet, which is typical for a private company, especially one in this type of market. So we start with net income. To skip the business with equity investments and non-controlling interests, we just start with net income attributable to all, not just to the parent, just so we can avoid some complexity there. We add back depreciation and amortization. The change in operating assets and liabilities. Remember, we already have this from our analysis earlier. We can see that this is around 17% to 18 or 19% in the second year. The first year it fluctuates a little bit more, goes from negative 14% to negative 21% to negative 12%. And based on these numbers, you can now see why we have set our assumptions the way we have in the future period, because we want it to stay in that same general range of around negative 12 or 13% to around negative 17 or 18% as a percent of the change in revenue. So we have been over that. Now, the company is also purchasing a huge amount of short-term investments, which we have over here, a smaller amount of intangibles, and then also capital expenditure spending. Cash flow from financing, we really have almost nothing to say here. Some of these items we only have, like this one about the non-controlling interest, for the sake of consistency and to have something linking into it on the balance sheet. But truthfully, we could have just easily removed this and not been any worse for it. At the bottom, we have our net change in cash. We're linking our beginning cash balance to the last historical quarter. And then ending cash is just that net change plus the beginning cash number. And then if you go over to the side, we're doing the same thing for all the annual numbers as well. It really only starts to matter in 2016 because we don't have quarterly projections for that period onward. So in short, our cash balance goes up by a huge amount to around 800 million US dollars here by the end of the period. And our equity also goes up by an even bigger amount if you look at the numbers here. The reason that happens, of course, is because the company is diverting some of its cash to buy all these short-term financial instruments. So in a sense, it's almost ironic how this company's cash flow profile and their financial statements and how they change, it's actually very similar to what we saw for the much smaller private company, which is part of the reason why I picked this as an example to illustrate that even though Kakao Corporation and our business are totally different sizes, as a private company, some of the same themes will come up regardless of the size. One of those is that you often get accumulated excess cash balances and it's not entirely clear what to do with them. And often when you have relatively simple businesses, and I would consider Kakao Corporation also a relatively simple business, even though it's much bigger, just because of its business model. When you have that, often you get balance sheet situations where the shareholders' equity and the cash keep increasing up to a very high level, but then the other items don't change by nearly as much. So we see that occurring here as well. So that's about it for this lesson and the key points I wanted to cover. We could go through and check the numbers, but we've sort of already done that, and I've explained how and why these items change the way they do. We don't need to worry about adjusting these figures or statements or making them compliant with KIFRS or IFRS or US GAAP or anything like that, because as part of a public company now, they will have audited financial statements and they do present those. We actually do have a version of Daum's audited financial statements, so you can take a look at that if you really want to. To do a recap and summary now, information sources for this include the separated historical financial statements disclosed by the buyer and the investor relation presentation where they give the monthly active users. The revenue projections are all based on monthly active users and the revenue per monthly active user across different categories. We assume growth in both the revenue per user and also the total number of users over the next few years. The expense projections are tied to employees, and we assume a revenue per employee figure and assume that average employee labor and benefit costs increase over time. There's very little to say on the balance sheet and cash flow statement projections because these items are just not terribly important to a company like this. We projected the income statement by looking at the quarterly numbers, getting them going forward, and then summing them up to get annual numbers. The balance sheet and cash flow statement, there's less to say, but we typically use index and match when we have quarterly figures available. Otherwise, we make our own projections. And you have to be very careful to make sure that you are annualizing when you have quarterly figures and projections and not annualizing when you actually have annual projections for items on the balance sheet. For the cash flow statement, we're limited because as a private company, they have not disclosed the numbers for 2013 or really any time before this deal actually closed. It's a problem, so we created our own cash flow statement, which is a very real issue you sometimes encounter with private companies. And then finally at the end, I explained why and how the cash balance changes the way it does. A very high margin business, it doesn't need much working capital, it doesn't need much capex, and so its cash and short-term financial investments keep going up by a huge amount as it spends more and spends its excess cash flow to acquire those financial instruments. So that's it for this lesson. Coming up next, we're going to jump into the public comps and the precedent transactions. I'll explain some of how we found the information for them and how we narrow down the sets. And then we'll do the same thing for the other company that we're looking at, this business. And we won't go into it in the same level of detail, but I'll explain some considerations and how you might want to think about those types of items differently for a very small business versus a venture-backed startup like Kakao Corporation.